go through a simple example. Susan, I promised you would understand this lecture cold. And I promise everybody in this room that at the end of this lecture, well, Cheryl, you're a genius, so you don't understand this stuff anyway. But, okay, so let's just go a simple example. So if I put $1 million in a T-bill at 4.75 in 1 year, I'm going to get $1,047.50. In other words, if I put $1 million at 4.75 in 1 year at maturity, a T-bill's 1 year. I could buy a T-bill 6 months, 3 months, but 1 year T-bill, it's going to be worth $1,047,500. It's like a CD, Cheryl, right? If I put 100 grand in a CD at 5%, right? I'm going to have 105,000. I make 5,000. Does everybody agree with that? Does anybody, Mark, you agree with that, right? That's simple. Okay, I'm going to get a little bit more complicated, but not much more complicated. I'm just going to go backwards. I'm going to go to my banker and I go, listen, how much money do I need to invest in a T-bill right now to be worth $1 million in a year? So I get out my calculator, and it comes out to $954,653.99. So in other words, let me make it easy. If I have $1 million and I put $954 in a T-bill, I rounded the numbers. I've got $47,000 that I haven't used yet. So what if the $47,000 blows up? In a year, I'll have $1 million. Okay? Okay, now, Lori, I'm going to do that again. So, Lori, I got $954, right? So I walk in, okay, I'll show you another way. You could use that $46,000 for Coke, smokes, and jokes, or you can invest that $46,000 in something that'll leverage the market, guaranteed by regulated exchange, risk-defined, and absolutely guarantees profit, loss, and maturity. We can invest that in exchange-traded options. Now, so let's kind of go through it. Laura, I'm going to go through it. Here I am. This is you, Laura. Well, you look better than this guy. But so bottom line is, I go to my banker and I say, how much money do I have to invest in a T-bill to be worth $1 million in a year? And the banker says, 952, 380. I'm assuming 5%. I'm rounding up to 5%. And he goes, okay. So what does he do? A year later, the banker pulls up with $1 million. So it's guaranteed by Uncle Sam, because remember, Treasury bills are the safest thing on the planet. There's nothing safer. You have no risk in a Treasury unless the U.S. government blows up, at which time we only have to worry about bullets and water. Okay, make sure we have more bullets than our neighbor. It's a terrible statement. I'm just kidding. It's guaranteed by Uncle Sam. So here's what you've got. I've got $1 million. I write a check to the banker for $952,388.95. But I still got $47,000 sitting over here. I haven't spent yet because I got $1 million, Mark. What am I going to do with that $47,000? I'm going to put it in an exchange-traded option. Well, heck, that sounds pretty good to me. Does everybody understand that? Laura, you with me? You think you're with me. You're shaking your head yes, but you're really not with me. You're lying to me. I know you're lying to me. I'm kidding. Okay. I'm kidding. I'm busting your chops. Okay. Okay, so we understand the foundation of this product, Mark. Do you think you understand it? I mean, we're saying, okay, I'm just going to take my money, whether it's $100,000 or $500,000, $1 million, I'm going to put it in a 1-year T-bill, but I want to put enough money in the T-bill where I'm going to get 100% of my money back in a year. So if it's $1 million, I'm going to invest $956. If it's $100,000, maybe it's $96,000, because I don't want to have any loss in a year. I want to be if the market's down 50%, I want to be flat. I'm going to take the difference, I'm going to invest it in exchange-traded options. So let's kind of get into that. Let's finish building an index treasury.